Good morning, everybody. So, we've been waiting for what feels like an eternity for the budget this autumn. Unfortunately, it did rather disappoint. A lot of the rumoured changes in the lead up to the budget were omitted, which is really good news on the whole for high net worth individuals, entrepreneurs. Unfortunately, you've not escaped scot-free. But yeah, let's have a look at some of the key changes. So I think the headline really was that thresholds are being frozen again until April 2031. On the face of it, pretty good news. Thresholds could have gone down. Bad news, fiscal drag, the much maligned term, means that more and more people over time will get dragged into the higher rates, additional rates of tax. So just as a recap, the personal allowance is remaining at 12,500. The higher rate threshold remains at just over 50,000, and the additional rate threshold remains at just over 125k. The standard rates of income tax have also been frozen, which again is good news. It could have been much worse. So the basic rate remains at 20%, the higher rate at 40, and the additional rate at 45. The not so good news is that from April 2027, so 13, 14 months from now, there will be an increase in tax rates for property income and savings income. So property income, very much as it says on the tin. Savings income is fundamentally interest. So those of you with bank deposits or other interest-paying items, the additional rate will hit that. So there's going to be a 2% surcharge on each of the tax bands. So the basic rate for those income sources will be 22, the high rate 42, and the additional rate 47. Couple of obvious questions arise from this. Number one, in respect to properties, if you've got a decent portfolio of buy-to-lets, is now time to consider incorporating your property portfolio. We can cover that off at a later date, but it's a good reason to look at that again. And secondly, bank deposits. Is there a better answer? And I'm sure Matt can cover that off in his section later on. So the starting rate for savings is being retained, which means despite the increases, you've got that £5,000 tax-free level. And this means that people with income of less than 17,500 get up to 5k of savings income tax-free. So that extra 2% is not going to affect those of you with perhaps small pensions and a bit of bank interest on the side. So not content with upping the rates on property and savings income, they've also decided that the dividend tax rates are going to go up by 2%. This time, however, it's just the basic rate and the higher rate that's changing. For whatever reason, the additional rate is remaining at 39.35%, which is a bonus for those higher earners. But basic rate taxpayers and higher rate taxpayers will go up to 10 and a bit percent and 35% respectively. So alongside these new slightly higher tax rates for, let's face it, the majority of sources of income, HMRC are also changing the way that we can apply reliefs and allowances. Historically, we've effectively been able to offset them against the highest rates of tax, but now they will be applied first at the proper basic higher and additional rates in advance of being allowed against the two surcharge rates or the three surcharge rates. So that's income tax and the changes. So again, could have been a lot worse, but there are a few little hikes along the way. Turning now to national insurance, again, a very similar story. Thresholds and rates have been frozen until at least April 2031. So for employees, the main rate, which applies on income between 12,500 and 50,000, will be 8%, and the higher rate, income above 50,000, will stay at 2%. For the self-employed, again, no change. Class 4, which is on your profits, the main rate 6%, and the higher rate 2%. There is an increase, an inflationary increase in the rate of Class 2, which is the weekly payments. So they're going up to £3.65 from April next year. But the threshold at which you pay those also goes up slightly to just over 7,000. And for anyone who is currently non-UK resident and is taking advantage of making voluntary contributions to top up their state pension entitlement, that's been removed as an option from April 2026. So if you've got unused years that you're still able to top up, I'd advise you do that prior to the start of the new tax year. Capital gains tax, again, good news, no real changes or no changes at all to the headline rates. I think there was expectation that perhaps CGT rates may be aligned with income tax rates. So I think we can count ourselves lucky that that's not happened. The bad news is that effective immediately from the dispatch box, anyone who is looking to sell their company to an employee ownership trust, the capital gains tax relief, which was 100%, has been reduced to 50%. And just to rub salt into the wounds, that 50% that's taxable will not qualify for business asset disposal relief or entrepreneurs relief. Brings us nicely onto the uplift in rates for BADR, entrepreneurs relief, whatever you want to call it. That's going up, as previously mentioned, to 18% from April next year. So again, it's nothing that hasn't already been announced, but it's a bit of a hike in the rate. I think if you recall, a few years ago, that was a 10% rate. It's now almost doubled to 18%, or will shortly double to 18%. Incorporation relief. So this is where you transfer a business from a sole trade or a partnership into a limited company. Historically, there's been no requirement to claim incorporation relief. It's applied automatically. There's no real change to that, but you will have to notify HMRC on your tax return that you've effectively made this claim rather than it just being applicable. Why they've done that, I don't really know. It's not the end of the world. I think you could view it as a bit of a benefit, particularly property landlords who are looking at doing the incorporation, as alluded to earlier. This potentially gives you a bit more surety that HMRC aren't going to come knocking on your door in many years' time, because by virtue of making that disclosure on the tax return, it realistically limits their opportunity to inquire into whether the relief should have applied to a window of 12 months, whereas historically it would have been effectively open-ended. They also brought in some anti-avoidance provisions that apply to share exchanges and company reorganisations. Again, effectively, these are a bit nothing. If you've got good advisors such as RPG, nothing's really changed. We would have told you what the qualifying criteria were, but HMRC are just tightening the screw a little bit, putting them under a bit more scrutiny. But any bona fide share exchange company reorganisation is not going to be affected. It's just things that were a bit wishy-washy, let's say, that may now get caught out a bit more readily. So inheritance tax, the big one. We were anticipating massive changes to IHT. I think anyone who'd been watching the leaks in the lead up to the budget, or the lead up to 3, 4, 5 months prior to the budget, there were talks about capping lifetime gifts. There were talks about extending the 7-year rule. There were all sorts of things rumoured. And in the end, nothing really happened. And in fact, what we got was some relatively good news. But yeah, again, main headline, I guess, the thresholds are frozen again until April 2031. Quite a recurring theme of this presentation so far today. So your nil rate band remains as 375,000, and the residence nil rate band remains at 175,000. So this is, if we look at a married couple or civil partnership, that basically gives you £1 million between the two of you, and that remains. Hopefully, after April 2031, we'll see some inflationary increases in these thresholds, which haven't moved, I think, for 20 odd years, but don't quote me on that one specifically. The, again, already notified cap on agricultural property relief, business property relief, which has seen London awash with tractors, and Jeremy Clarkson talking about the blight of farmers for the last year or so. This will apply from April 2026. So historically, all of your business or all of your farm would have been exempt from inheritance tax effectively. But from April next year, the 100% relief will only be for the first £1 million of value, and anything above that will only get 50% tax relief. The good news that came out of the budget is that they're now going to allow unused allowances to be transferable between spouses. So exactly as the nil rate band and the main resident nil rate band, you've now got this APR, BPR £1 million allowance that you can transfer to a surviving spouse. So that effectively, on second death, gives us a £2 million cap, which is quite a significant uplift on where we were, or where we thought we were going to be, at £1 million. So there's also been some mentioning or a bit of clarification around offshore trusts settled by former non-DOMs, which ties in with the abolition of non-DOM status from April of this year. These so-called golden trusts, which were previously completely outside of the scope of UK inheritance tax, the government have now very kindly said that they will cap the amount of IHT payable at an eye-watering £5 million. But again, it's all relative, and there will be a lot of people who are very happy about this £5 million cap, despite the fact that seems like a crazy number to us mere mortals. There's also been an announced tightening of certain loopholes around IHT. Firstly, probably relatively innocuous in the grand scheme of things, but charity exemptions were going to be restricted to direct gifts to UK charities and clubs, and that will be effective from November 25 for lifetime gifts, and from April 26 on death gifts. So just as a recap, charitable gifts are brilliant. If you don't want to pay any inheritance tax, leave your whole estate to charity, and there won't be a penny of IHT to pay. Your beneficiaries may not be too happy, but it's the easiest way to avoid inheritance tax. The other aspect which got tightened down was around UK agricultural property. So historically, or currently, commercial premises wrapped in offshore trust vehicles are not subject to UK IHT, whereas residential property is. They've now extended that to UK agricultural property as well, and that will be treated as a UK citus asset from April of next year. So the other big change, again, a previously announced change, but from April 2027, so we've got a bit of time, your pension pots that you've spent a lifetime saving into, expecting them to be outside of your estate, are now going to form part of your estate for inheritance tax purposes. Again, I know Matt's got some cunning little plans to potentially get you around this issue, and he can talk about those later. But that's quite a big change. Pension savings again, April 2029, so a very long way off, but worth thinking about. Salary sacrifice, which a lot of companies, a lot of individuals will be taking advantage of. The contributions that benefit from reduced employee and employer NICs are going to be capped at £2,000 a year. So if you're currently a high earner doing 5–10% salary sacrifice, your NIC savings are going to be capped at £2,000 from April 29. But just to put this in context, that's NIC. If you're a high earner, you're talking 2%. So it's an additional 2% effective tax on your sacrificed salary for the pension. The good news is no changes are being made to the income tax relief. So for those of you at the 45% rate, you're still saving 45% income tax, but you're just going to get hit with an extra 2% NICs on sacrifice above 2K. So it could have been a lot worse. Again, we were expecting potential abolition of the higher and additional rate reliefs on pensions. So this is a win, I would say. ISAs, again, fundamentally, no real change. The limit is £20,000 for ISAs. Lifetime ISAs stays at 4K. Junior ISAs stay at 9K, and they're frozen until April 2031. For those of you over 65, there is no change whatsoever. For those of us under 65, the ISA limit will basically be broken in two. So you've got a £20,000 overall limit, but only 12,000 of that can be saved in cash, meaning that at least £8,000 will have to be invested in stocks and shares. The idea of this is, I guess, the government wants to encourage people to invest in markets. The reality is a lot of people will probably invest in the US market because the growth there is outstripping UK funds. But on the flip side, for you as individuals, you're likely to see a better return from investments than you are on cash. And again, Matt can give a bit more of a background on that in his section later. So it's not all bad. This is just a slight admin headache, I guess. Other key points, and again, this one could have been a lot worse. There was talk about a full wealth tax. And we've managed to escape with what they're calling a high value council tax charge, which is going to apply from April 2028. So again, fair way into the future. And that will apply to property in England worth £2 million or more. So if you've got a £2 million plus property, you'll be paying £2,500 a year in additional council tax. If you've got a property worth more than 5 million, you'll be paying £7,500 a year in additional council tax. One of the reasons for the delay in implementation of this is that the government have got no idea how they're going to do the valuations of the properties. And as most of you will be aware, council tax in this country is still based off values of property back in the 80s. So it's a very outdated system. So it needs a bit of time to come up with an idea as to how to implement things. VCTs, again, we'll look at those in a bit of detail later, but the headline is that the tax relief on subscription for VCTs, venture capital trusts, is being reduced from 30% to 20% from April 2026. The aim of this is really to differentiate between the VCT and the EIS, Enterprise Investment Scheme, with the EIS deemed to be a riskier investment, and therefore the tax relief should be a bit higher on that than it is on the VCT. The other point of note, and it doesn't really change anything in your personal tax situation, but for those of you with crypto assets, which is a more and more common investment class we see amongst our clients, the service providers, the online dealers, whatever you want to call them, they are going to be forced to report to HMRC from 2027 onwards, and that report will cover transactions from January 2026. So if you've got crypto assets, make sure that they're being properly reported on your tax return, because HMRC is going to be getting data from 2027, and they will be opening inquiries into a number of individuals' tax returns off the back of that, I'm sure. So just as a bit of a recap on crypto, as far as we're concerned from a tax perspective, a crypto asset is no different to any other equity, stock, share, fund, in that when you sell it, you trigger a capital gain. Now, a sale isn't just a sale for cash. If you've got Bitcoin and you're transferring that into Ethereum or Trump coin or whatever other one you're moving into, that switch from one coin to another is a sale for CGT purposes and an acquisition for CGT purposes. So every time you're moving from one crypto to another crypto, that's triggering a disposal, and that needs to be reported on your tax return. Again, if anyone's got any questions around that, then please do not hesitate to ask. So that's the budget recap. As I say, it could have been a lot worse, and I think myself and many other advisors think that, yeah, we've got off lightly as a taxpaying public, and so not all bad. So moving on, we're getting close to the tax year end. We've got 3 and a bit months left, which is a perfect time to look at some tax planning. Not going into any real heavy detail in this session. It's just an opportunity to give you some ideas, some thoughts that you might want to be considering. And if you want a deeper delve into your own personal situation, pick up the phone, drop us an email, and we'd be very happy to go through that with you. So number 1, make sure you maximise allowances, personal allowances, property and savings allowances, dividend nil rate bands. These can save you a lot of tax. For those of you who are suffering high marginal rates, so incomes between £100,000 and £125,000, where you're paying an effective rate of 60% tax, consider things like increasing your pension contributions, making charitable donations. They can be very tax effective. They can bring that bracket down, so you're not paying 60% on as much of your income. You've also got options to consider tax efficient investments. As I mentioned earlier, we've got EIS, we've got SEIS, so Seed Enterprise Investment Scheme. Whilst these don't reduce your tax rate, they do reduce your tax liability. So just as a recap, an investment into an EIS, 30% tax relief. An investment into an SEIS, 50% tax relief. An investment into a VCT, currently 30%, dropping to 20% tax relief. There's also CGT deferrals on SEIS and EIS investments, which means they could be quite useful if you've realised a big capital gain, invest some of the proceeds into EIS, SEIS, defer that gain, save some income tax, and then you can do a sort of rolling cycle. But again, Matt's your man to talk about EIS, SEIS, and he'll have some products or some opportunities available to you. So the 60% tax trap, I've just alluded to this, but where you've got income in excess of 100,000, you're going to lose £1 of your personal allowance for every £2 by which the 100,000 is exceeded. So we've got a personal allowance currently of £12,500. So once your income goes over 125,000, your personal allowance goes to nil, which gives you an effective rate of tax on that 25k of 60%. So gift aid, pension contributions, they can help sort of redress that imbalance of paying a very high marginal rate of tax on an amount of your income. Spouses, civil partners, again, we often see one spouse is a higher earner than the other. And a lot of people don't necessarily think that there's opportunities there. So if you've got a higher earning spouse, where you've then got investments, don't have them in the name of the higher earning spouse, potentially don't even have them in joint names. Transfer those assets to the spouse with the lower income, and that could give you an automatic tax saving just by reducing the rate of tax chargeable on those incomes. And the good thing about this is where we've got spouses, civil partners, transferring those assets between you is not going to trigger any capital gains tax risk or any inheritance tax risk. So you're free to just manipulate and move assets between the two of you, with the exception of ISAs, but it's irrelevant, they're not taxable. So it's a really good thing to look at, and it can be looked at any point without much consideration to anything else. So EIS, SEIS, I've already really talked through this, so won't go into a bit more detail. The main thing to note is these are high risk investments, hence the tax relief. So yeah, I wouldn't be throwing money into these in anticipation of huge upside, although I have seen them over my time. But the risk is somewhat mitigated by the upfront tax relief and the fact that if you do make a gain, you're not going to be paying any tax once that gain crystallizes. Pension contributions, again, we've covered the fact that from April 2027, your pension pots are going to form part of your estate for IHT purposes. But I don't think this necessarily means people should stop making pension contributions overnight. Pension contributions are still subject to income tax reliefs, which could save you money now. And if your income's going to go down in retirement, you can put some money into a pension at 45, 47% tax relief and take it out at a later date when you're paying 20% tax. You've made a 27% tax saving effectively. So it is still a good opportunity. So just as a recap, all UK residents under 75 years old can receive tax relief on contributions up to 100% of their employment or relevant trading income. This is subject to a maximum, the annual allowance, which is £60,000 for current tax year. For those of you with high incomes, those in excess of £200,000, we need to start looking and considering whether this allowance is tapered. There's two key terminologies here: adjusted income and threshold income. Why they've picked those names, I don't know. Threshold income is fundamentally your employment income or your total income, less pension contributions. If that is over £200,000, then we need to consider adjusted income. Adjusted income is fundamentally the same, plus employer pension contributions. So for those with an adjusted income over 260,000, you will lose £1 of your annual allowance for every £2 over the threshold. Once your adjusted income gets to 360,000 or above, your annual allowance will be tapered down to the minimum of £10,000. It's also worth considering that unused allowances, so the 60,000, can be carried forward for 3 years, and these are used on a first in, first out basis. So if we go back 3 years, 22, 23, if you didn't make pension contributions then, you've got 60,000 of spare allowance, as long as your incomes were below the thresholds, that can be used up this year. For next tax year, that 22, 23 will disappear. And then we've got 23, 24, 25, 26, etc. to carry forward. If your pension contributions exceed your annual allowance plus brought forward allowances, then the excess pension contributions will be subject to income tax at your marginal rate, so most likely 45%. There's another point actually on the pensions, which I think is often overlooked, being that if you've got children, we're all aware of the junior ISA, but there's nothing to prevent you making contributions into a pension for a child. They could put £2,880 net in each year, and that will get topped up by the government to £3,600. So 20% uplift, tax-free growth. Start saving for a pension at 6 months old. You're going to be in a pretty happy position come retirement, hopefully a lot younger than 65 if you start your pension savings that early. So it's just something to consider. Capital gains tax planning. I think the key point here is don't forget to make use of your annual exemption. It may only be £3,000 now, but that's £3,000 per individual, so £6,000 of gains per couple per year that can be realised without a tax charge. If you didn't take advantage of that and just rolled up and rolled up and rolled up, in 10 years' time, that's £60,000 of gain that will now be taxable on realisation, which wouldn't have been if you just took gains year on year. So how can you take these gains without necessarily changing your investment strategy? Two options really: bed and ISA. So by this I mean sell some assets, realise the gain, and then rebuy those same assets immediately in your ISA, and that way we haven't got matching for CGT. Or bed and spouse. So you sell your shares in Shell, for example, realise £3 of gain, gift the proceeds to your husband, wife, they reinvest immediately in those same shares, and that way you get continuity of ownership, but you've managed to realise a tax-free gain of £3,000, which should minimise tax liabilities going forward. Inheritance tax planning, again, similar theme. Make use of your annual exemptions and small gift allowances. So annual exemption, £3,000 per donor per year, and you can carry forward 1 year. So if you didn't make any gifts last year, you can do £6,000 this year. And again, that's per person. So across a couple, if you didn't do anything last year, £12,000 you can get out for your estate without any issue whatsoever. Small gifts, £250 per recipient per year. Can't be combined with the 3K, but it's there. Marriage gifts, £5,000 for a child, £2,500 for a grandchild, £1,000 for anybody else. So you'll be the most popular guest at a wedding, and you're also getting a good chunk of money outside of your estate for tax purposes. The golden ticket for those of you in a position to do it is that normal expenditure out of income is always exempt. So if you've got, like a lot of people do, big final salary pensions, and you're bringing in an income of £100,000 plus a year from these pensions, and you just don't need it all to support your living, you can give as much of that away as long as it's done on a regular basis. So that could be once a year once a month, once a week. But if you're making regular transactions out of surplus income or regular gifts out of surplus income, they are IHT exempt. They will never fall back into your estate. Again, if you've got any questions around it, please don't hesitate to give us a call. Other options, and again, I've just put two big highlights up here because they're huge topics of themselves. But I think for a lot of people, when they're talking about estate planning, what they're really worried about, well, twofold. One is the IHT liability. Two is ensuring that their hard-earned money stays within the family and is protected for future generations. There's two ways of doing that. The traditional way, the old-fashioned way, is the trust, which maybe isn't the most tax-efficient option, but in terms of protection for future generations, it's by far and away the best product on the market. The other option, which is probably more familiar to those of you with limited companies, are the family investment companies. Sounds clever. It is just a normal limited company, but with a well-drafted set of shareholders agreements, articles of association, we can get a lot of the benefits of the trust, but in a format more familiar to yourselves. Again, too much to go into on either of those topics today, but if anyone wants to have a chat about trusts, family investment companies, general planning for next steps of life, then please do give me a call. And I think just one final point to make from me before I hand over to Matt is that this has been a very whistle-stop tour, generic overview of reliefs and planning opportunities. There's no substitute for bespoke tax and financial planning. And working with a firm such as RPG, where we've got tax advisors and wealth managers in-house, by working with us, you ensure that you've got seamless connectivity between your professional advisors, and we're both working towards a common goal. And that just means we're much more likely to be able to meet your objectives than if you've got a tax advisor over here and a wealth manager over here. That joined up thing, it's really good for you and good for the next generation. And on that note, I'll hand over to Matt, who can pick up on some of the financial planning points.
Thank you, Adam, and good morning all. Adam has covered off quite a lot of the changes in the budget and subsequently how we are seeking to advise clients going forward on their personal matters, but also their family wealth management plans. So I'm going to cover off some other impacts in terms of how it changes how we advise private clients and their families within the financial services and wealth management department. Again, a quick recap, and I'll not dwell on these because Adam did cover them in some detail, but there will be a change to the ISA allowances going on from 2027. And importantly, it was the way that Miss Reeves framed it on the budget a couple of weeks ago, that there is the requirement of £8,000 of the usual ISA allowance that's required to be invested in stocks and shares, effectively capping the cash ISA allowance at £12,000 for those that are under the age of 65. And as Adam did touch on it, trying to understand the rationale for it is to try and encourage more individuals to invest into stocks and shares to try and deliver a higher savings ratio for the public. She did also quote, if I can remember it accurately, if somebody had invested £1,000 per year into a stocks and shares ISA from 1999, that today they would be £50,000 better off than if they had invested that in a cash ISA. So there's it's a very crude quote without really any background detail as to what stocks they're invested in, what fund they're invested in. I'm sure there'll be scenarios outside of that where the return will be significantly higher or significantly lower than that £50,000 difference. So just furthermore, it's demonstrating the requirement to review the investments that you're owning. Are they suitable? Are they delivering return? And I'll touch more on that in the next slides. So jumping on in terms of this, equally, we have a couple of years before the changes to ISAs happen. So you do still have the full £20,000 ISA allowance this tax year and next tax year if you wanted to invest into cash ISAs. Now, where typically somebody why would you have a cash ISA? If you're looking for retirement income, if you have a low risk profile, or if you're slightly older and you don't want to expose any of your assets to market volatility, then you would seek to invest into a cash ISA. But it's worth noting there that there are some banks and some investment providers offering cash ISAs with a low interest rate. So it is worth shopping around. It's the same way you would shop around for your car insurance or your phone bill once a year if you can be bothered to do that. It is worthwhile spending the time to do it because there are offers that are available to you. And with interest rates still elevated relative to recent history, there is still some good opportunities out there. And I was looking this morning and there is still a cash ISA offering 4.1 to 4.5%, so higher than base rate at the moment, so worth checking it out. Again, contact me after this if it's of interest and I can direct you towards something. Again, talking about how we can implement ISA allowances for family planning, as I've noted at the bottom of the slide there. A junior ISA is a ISA allowance aimed at under 18-year-olds. Again, funded typically by parents, but can also be by individuals. The ISA allowance for that is £9,000 per year and can be invested in stocks and shares or cash. there is the ability for a 16-year-old to also take out a cash ISA with current limits. So between the ages of 16 to 18, a individual can contribute, or the child can contribute towards an ISA allowance of £29,000 a year. Now, this is the only time where you can exceed the £20,000 a year. So again, if you're starting to plan for the next generation or starting to consider some IHT planning, this is a route that can be taken and can be quite effective. Worth caveating, when that individual does turn 18, it is their money. You cannot determine how they spend it. If they want to extract it to go on holiday or buy a flash car, you don't have the control to tell them what to do, unless you're educating them along the way that it's intended for a certain purpose. But something to be mindful of. Adam did touch on it as well in terms of the lifetime ISA. The lifetime ISA's core objective is to assist with individuals purchasing their first property. The current limits are you can contribute £4,000 into a lifetime ISA, and the government will top that up by an extra £1,000. There is the cap of a property of £450,000. If you purchase a property that exceeds that, you can lose the additional tax, that the additional benefit that the government offers into it. So worth noting that there aren't a huge range of properties in the southeast that are around the £450,000 mark, but equally there are some. And depending on the age of the individual and when they're seeking to purchase that property, it might be just checking whether this lifetime ISA is suitable for you or not. I did say it has a dual mandate. The second benefit that could be that benefits a lifetime ISA is, at the moment, you can contribute it after 60 and you do not lose the additional government bonus. So there are opportunities where, if you're seeking to save for retirement, you can save into a lifetime ISA, contributing £4,000 a year, and get that £1,000 bonus. And if you take the money out after 60 or use it to draw an income in retirement that will be tax-free within the ISA rules, there's no penalty on that, even though you've not used it to buy a property. So that's why I believe there will be changes in the new year as to how the lifetime ISA is extracted and or when it is extracted, because this dual mandate currently offered by the lifetime ISA, I don't think it's suitable, and it's not aligned with the primary, which I believe is to assist individuals purchasing their first property. Again, if an ISA is something that you're considering with additional income, do reach out and we can have a conversation as to which wrapper is the most appropriate for you. And then once we've got the wrapper organized, it's then the underlying investments where I think we can add a little bit more value to you as well. So do reach out. Now, Adam did touch on the pension contribution aspects in terms of the salary sacrifice change that was announced in the budget. Now, there is a few years before this is enacted, and I'll not go into any further detail other than highlighting that bottom sentence. If an individual currently sacrificing £10,000 of their salary to contribute into a pension, the additional tax charge to the individual will only be £160. The larger impact is to the employer there, which is at £1,200. So the impact of this change, albeit in 4 years' time or 3 years' time, is going to be largely on the employer. And how are they still going to offer the salary sacrifice as a means of remunerating their employees, or are they going to look for slightly other ways to benefit those individuals? Again, that will come out over the next few years whilst we start to put these things in place. Again, the planning angle of this, if you're still intending to save, it still makes sense. There is no change to your current circumstances for the next 3 years. And as I highlighted there, as an individual, the only change for you doing so will be an extra £160 tax charge, which if you're able to save £10,000 a year into your pension and your tax charge is only going to be £160 rather than the additional income tax you might be receiving and NI elsewhere, it's still a sensible decision to do so. But again, come and have a conversation with me whether the pension contribution is the most suitable for you, or the ISA or another tax vehicle. Adam did mention the changes to VCTs with the income tax relief on a venture capital trust going from 30% down to 20% in April 26. And as a back of that, there was a very large increase in investor demand after the budget, with some venture capital managers receiving record-breaking amounts of investment. So there is still high demand for the venture capitals and EIS investments for those high earners that are seeking to offset some of the income tax. Now, I did say I wasn't going to dwell on too many of the changes, but what I'm showing on the screen here now is individual tips for yourself. How can you review your personal circumstances? Now, when we advise a client, we have an annual suitability assessment. Now, we've titled it there, a financial health check at the top. Now, this is a full, in-depth, holistic review of all the investments you've got, your income, your expenses, your protection, your IST plans, and we'll sit down with the individual and go through these step by step. And we've touched on how the individual tax products can benefit individuals and their families, but quite importantly is, are they invested correctly? Now that's something that we can assist with and I believe add some significant value in finding the most appropriate investment for you at any one point, and ensuring that each of the individual tax wrappers have the most appropriate investment for what you need. And I touched on it earlier, whether a cash ISA is more suitable if you're seeking to draw an income versus a pension. Now, if you were of a fortunate position to be able to leave your pension, or were planning to leave your pension for the next generation, that is now highly taxed. That will be highly taxed and is very unsuitable now. Now, Adam did confirm I will be talking about that. I don't want to give too much on this call, but there are plenty of planning angles where we can use current rules and current products to still provide that next generational wealth transfer without incurring too much tax. So if you are one of these individuals or had planned to leave your pension for the next generation, do reach out and we can have a discussion around what the different planning angles are. Equally, alongside our annual suitability check with individuals, there is only one guarantee in life: the circumstances do change as you get older, as you change your jobs, as you move house, as you get married, as you have babies, the list goes on. And we need to review the investments to ensure they are suitable and whether the risk profile is correct, and if there are any tax changes to any of the products that we're recommending. So the landscape is forever changing, and that is more of a reason to have an annual review and ensure that your investment plans are chancellor proof at the bottom there. Now, I know that is quite a hard task, but this year we had lots of leaks and lots of hints and suggestions which we can review. Now, I don't ever recommend that we act in haste or act on speculation, but if you were planning to make a decision over the next 12 or 18 months that were rumored, then it may have been prudent to do so. But I will reiterate that always having a clear plan is best, and being flexible where possible will benefit yourself and your family long term. So if any of what I've discussed today or Adam has discussed does impact you individually or with your family as a backdrop, do reach out, and you'll be pleased to know that's the end of my slides. So I'll hand over to Kate, who will wrap up the presentation.